Occupancy and cap rates don't really matter. NOI matters. I would rather have more revenue and net income than I would occupancy. When I hear somebody bragging about being 100% occupied, man, I start to salivate. Because what that means is they're not actually looking at supply-demand opportunity. They're not pricing. It has nothing to do with revenue at all. That opportunity is where you make your money. And using this simple strategy can help you find the opportunity or maximize the asset that you already own. This simple methodology will show you facilities that have massive opportunity, income growth, and a lot of wealth to be captured through increased equity. Also, how to get it out of your facility today. Now, this simple methodology that I use goes back to a core principle that self-storage is a business more than it is a real estate asset. And when you treat it like one, that's when you can get huge gains. This methodology was something that I worked on and created after the great financial crisis. Before that, all our facilities that we had and owned were treated a lot more like real estate, and I was trying to develop strategies and techniques to operate it like a business, like my other businesses, to increase the value. After 2008, we really worked and perfected this. The reason being there was more inventory on the market. There was less demand. So this became even more important. In times like we're in today, where demand has dropped after the COVID boom and occupancies have come down and street rates have come down, this is more important. But it also opens up for way more opportunity and upside. This methodology is simple. When we talk about things like dynamic pricing, revenue management, and all of this tech and tools, you can go back to a very, very simple process that you can do on a spreadsheet. It's simple for everyone to do. This methodology can also show you the money on the table, as I call it, meaning that asset that you're looking to buy, wondering what's the potential and what can I get out of this? How can I increase revenue and net income through this asset that you're looking at? It's on the market or it's off market, and you're really trying to understand, not future. We're not talking about future upside because the market will get better, but today, the money sitting on the table today. So let's break it down. First thing, remember I treat units as products and tenants as customers. That is because in a storage facility, you can have lots of different types of units. These different types of units attract very different customers. And in a marketplace where you have lots of competitors, the supply that is on the market is not evenly spread. This is a large misconception. What that means, when I look across our facilities, ones that are in markets that are struggling, the struggle in occupancy and even rental rates is almost always concentrated within just 3 different types of units. So you can have a storage facility that has 10, 15 different types of units. That may range from everything from large 10 by 20 enclosed drive up to a 5 by 5 climate controlled. Or it may just be 8 different types of drive up. But it still attracts a very different customer. Now, this could be anyone that's maybe, let's say, living in an apartment and just needs more storage space, to a business that needs to utilize that asset a lot to run their business and logistics, maybe last mile. Now, this could also be from someone that is moving and they need to put a place to put all of their furnishings and everything in their home. This could be a spot to store toys. I'm talking about RV and other things. There's a variety of different customers and uses that need very different products. And in a marketplace, sometimes individual products gets massively oversupplied. We see this a lot in markets where they built lots of 10 by 10s. So demand didn't go down, but supply went way past on that single product type than the market needed. Now, that same facility that may have low occupancy because it has too many 10 by 10s, they may have a set group of, let's say, 10 by 20 enclosed drive-up where the market is undersupplied. That unit is in high demand and they're fully occupied. So the first thing that we look at is the actual products and the customers. Now, using this simple methodology, we break those down even further and simpler, not by unit type, but by category. Here are the 3 categories that I want you to use. Let's say you're looking at a facility. Take all the units and break them down into 3 simple categories. The first is the control inventory. Now, this is inventory that you control in the marketplace, or there's just so much demand, you can really control the pricing. The second group is our advantage group. This group may have high demand, high occupancy, but it may vary a little, but still there's good demand in it. Now, although you may have lower occupancy, there's high demand and people are coming in and buying and you have a lot of turnover, which that can be really, really good. Our third group is the commodity group. That is where there's too much of that product and that product just becomes a simple commodity because there's so much of it in the marketplace. And so people only care about price because there's options everywhere. Okay, I'm going to break this down and we're going to look at the numbers to show the effect and what you do with this. First of all, if you're listening to this on the podcast, if you want to go over to the YouTube, there is some visuals, but you don't need to. Second of all, if you're on YouTube watching this, or even on the podcast, everybody, please leave a comment. Tell me what you're doing today and how you are improving revenue, even in markets that may be struggling, or finding opportunity that is unrealized by the current owner. And as always, like and subscribe because, guys, that's the currency of podcast and YouTube, and that's what you can do to help me for sharing this information. All right, let's dive into it. All right, since I know my listeners are self-storage nerds just like me, I want to share with you ways that I've seen other people get started in self-storage. So you may not know, but I wrote a book that's hard to even call this a book. I mean, this is a manual. We're talking 400 plus pages, which include all sorts of information about how we have been in the self-storage industry. That's everything from how we got our first deals, to scaling, to buying deals in today's market, what's changed and what remains the same. This is an up-to-date book that shows you how the market has changed and how you can win today. This isn't simple, this is how you buy a deal. No, this goes into everything, including how you scale and create a self-storage business. You can get a physical copy, an ebook, or the audiobook, plus free access to bonus content at the end of each chapter. You can get it today. It's available on Amazon and other platforms in which you can follow the link. First, let's take a look at a 300-unit storage facility. We can break these tiers down. Now, as you can see on the image, and if you're not on YouTube, that's fine. These tiers are broken down, and let's say we have 60 units that are within our controlled group. We have 150 that are in our advantage group. And then we have 90, which is in the commodity group. You see, how most real estate works is we go on occupancy and we use our rates to rate things kind of as it is, meaning that the rate that is applied, we apply to all units. So we have 10 by 10s, they're all the same price. We look at the market, see what rates they're putting, and then we try to compete on the market with those rates. Now, this can be a fundamental flaw, meaning that you're actually competing on price with people that you don't need to, because your demand, your supply is totally different than theirs, yet they're now dictating the price that you're in. Hence the reason why you need to look at these 3 groups to identify the differences. So for this example, we have our 90 units that are scarce. Maybe we have something that other people don't, like a trickle charge. There's some advantage in that unit that is rare in the marketplace, or maybe even it's just simply a lot of demand for that type of unit in this marketplace. It's also important to remember that demand for different types of units fluctuates. The difference in demand for maybe larger units 5 years ago was really high, and maybe it's lower today. So you want to look at the history and see how things have tracked. But really, we're just focusing on now, what the market is telling us right now. We have that second group of advantage units, which is 150. That's the bulk of our units. Now, we may have low occupancy, though, on this overall 300 units. The reason being is we have 90 units that may be struggling. These are the very sensitive to price. The lowest price takes it because people have options. So how typical pricing goes, we are going to give a 3% rate increase because we're trying to keep up with inflation. Now, that may vary a little, or maybe some will give a little more and others we won't, because we can see that we're trying to fill up those units. But operators may be looking at it saying, my occupancy is low, so I just need to cut rates, even though the products that they're selling have individual supply and demand. Or they may be scared to raise rents because they don't want that occupancy to be lower, so they don't want people to move out. This is a fundamental flaw. Now, let's take a look at the impact of what we can do with these three different groups and how different pricing strategy works. So, as a baseline, we're looking at a storage facility in the marketplace, or we have a storage facility, and that facility does roughly $486,000 in total revenue. The net is $315,000 roughly. Now, at a 6 cap, that prices this at $5,265,000. Now, we can go with the traditional, let's just give a flat increase. We don't want people to move out, so we're going to give a 3% increase that's keeping up with inflation. We don't think it'll bother people, and we can really focus on occupancy and trying to fill units up. That would result in changing that NOI to roughly $325,000 and change from $315,000 and change. That then results at a 6 cap, keeping things exactly the same, a value going from $5,265,000 to $5,422,000 and some change. We had a very big jump in the overall value. You just made in value roughly around $200,000. But now let's look at the tiered pricing model. Now, this is where it gets interesting, because instead of just giving a flat rate increase, we actually will lower rates on our group that is the commodity group. So for this select group, we're actually dropping rates. We're going to drop that commodity group by 5%. So we're going to lower rates by 5%. Now we're going to move to the advantage group. The advantage group, we're going to look at those high demand units within that advantage group. We're going to look at the ones that have turnover, but they're constantly being replaced. We're going to look at individual units where they're priced, and we're going to give, let's just keep this really simple for the whole group, a 10% increase. And now for our controlled inventory group. Now, remember that represents roughly 15% of our units, but these units are really high occupied and high demand. For those, we're going to give a 20% rate increase. Now, at first that sounds shocking, but you got to remember in storage, that's actually common because the overall increase is small on a dollar amount compared to other real estate groups. What we assume is that actually we will lose some occupancy, which that is good, because in high demand units, we actually want inventory to be able to sell. So we can increase those in-place rates, but we can also have a very competitive street rate that is higher. Why? Because we know so many people want it. We don't need all customers, especially with only 15% of the units. We only may have 5-6 units to sell, but we have lots of people that want them. That means the people that are coming in to take those spots from the people that moved out are now at a higher rent than even the rate increase that we gave because there's only a few of them. So the market's competing for them. For that advantage group that we gave a 10% rate increase, for that group, we assume also a small drop in occupancy. Now, one of the things you want to do is make sure that people are enrolled in auto pay. And I want to track the churn to see if it changes. Meaning a lot of people give rate increases, people move out and they freak out. But if you look at the past year, that churn actually may be very, very small in comparison and fits right along with normal churn levels. Meaning the people were going to move anyways. That didn't change anything. So what we want to do is we want to give that rate increase. As inventory opens up, we do targeted rentals at a higher rate, the same as we're doing in that top group. And we want to focus on that for our marketing. Why? Because that makes up the bulk of the units and a lot of that opportunity. Where those top controlled units, there's so little of them and there's so many people that want them that they're going to naturally come in and try to get them. So we don't need as many marketing dollars spent there. For the lower group, we're dropping rates by 5%, allocating market dollars there because we are now competitive and maybe the lowest price in that market. That's what you're going for. And so now you're capturing people that are price sensitive and working on occupancy to actually fill it up. Therefore, you're offsetting any drop in occupancy in some of the lower groups, but your overall rental revenue, your income is rising. So how does that change versus a flat 3%? Well, our baseline NOI was $315,000 and some change, 900. Let's call it $316,000, that baseline group that we were working with from the beginning. Doing the tiered pricing, even losing some occupancy and lowering the rates, our net income actually rose to $336,000 and change. Compare that to our flat rate increase, in which we got $325,000. So we have a meaningful jump from our base to our new level, even decreasing rents and also losing some occupancy. Our baseline change in value at the exact same cap rate moves from $5,265,000 and some change to over $5,600,000. We got over a $400,000 roughly jump in value with a lot more net income. Now, this goes back to a principle that I talk a lot about, where occupancy and cap rates don't really matter. What I mean by that is that NOI matters, the focus acting like it's a business on revenue and net income. So would I rather have 100 units where everybody is paying $100 and it's completely full, or would I rather have 90% vacancy, but the 10 units that I do have, each person is paying $10,000 a unit? I know that's absurd, but the point is clear. I would rather have more revenue and net income than I would occupancy. And I don't treat individual products the same in pricing, marketing, or anything else. So now when I'm looking at a storage facility, what I do is I take their units, their occupancy, their rates, I put them into 3 different groups. I look at that operator in that facility, break it down into these 3 groups, and I see the controlled group, the advantage group, and the commodity group. And I can see where we can really drive prices, where we need to lower prices, increase occupancy, and that huge middle of opportunity. Now, although the rate increase may be less on the middle because of volume, it still has a big impact on revenue while not substantially killing our occupancy. We're talking about meeting in the middle. We are talking about occupancy only in relationship to revenue. This will then show me on that facility where money is left on the table. Not future prices, but right now where their pricing strategy doesn't align, doesn't match up to the market. I can also see where I need to be marketing, spending ad dollars, and attracting certain different types of tenants, or as we call them, customers. So remember, when you're looking at a facility that has lots of units, Not all units are the same. Supply and demand is different. Not all of your customers are the same. And you need to price it that way, just like any business that sells different products to different people. No technology, no fancy dynamic pricing, revenue management systems, just looking at your market, the products and who are buying them, grouping them up and creating a pricing and rate management strategy that reflects those products and those customers in the market. This is the strategy that we used a long time ago before we ever had any of the fancy software or anything else, and it worked great. It especially works great when you're buying properties from mom and pop operators, which is a huge portion of the self-storage market. They are not looking at rate management, revenue management. They're looking at occupancy, and they just don't want problems. Lots of them brag about being 100% occupied. When I hear somebody bragging about being 100% occupied, man, I start to salivate. Because what that means is they're not actually looking at supply-demand opportunity. They're not pricing. It has nothing to do with revenue at all. That opportunity is where you make your money. And using this simple strategy can help you find the opportunity or maximize the asset that you already own. Tell me your thoughts if you guys are doing this, or if you're looking at a facility but not sure how to underwrite and analyze it, and if this helps you out. Once again, like and subscribe, everybody. That's how you can help me to keep putting out this information. Thanks.